Good morning, good afternoon, good evening, everyone. Michael Zuber, one rental at a time, and it is Thursday, and I'm back with my good friend Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you?
I'm doing very well. Hey, I just want to let you know your Facebook group is amazing. You moderate it well. You kick out the people that shouldn't be there, and you also post just these amazing kind of. I almost look at them like Jonathan's like deep in thought, posts. And you put one out the other day. I'm going to call it zig when others zag. I always call it running away from momentum. I'd love to talk about that because I think that's the key to investing. And right now, there's a lot of people going one direction, especially in multifamily. And I thought your post was like, hey, everybody, look over here. This might be safer. Let's talk about it.
Well, yeah, I mean, safer or just an easier way to get, some traction. And, I think one of the things I've always been interested in about investing in markets is herd mentality in markets, right? Markets suffer a lot from herd mentality. And usually the dynamic is, you start a cycle with a crash, right? And the crash scares away all of it. I mean, really burns the people who got in late, and it scares away everybody except the really savvy investors who recognize that it's an opportunity, right? And so what you have is, prices drop because most people are out of the market. They go on the sidelines. Most people believe, like, because of recency bias, that since a crash just happened, another crash is likely to happen. When the opposite is actually true. If a big crash has just happened, another crash is not very likely because you basically, the prices have dropped so much they can't really drop that much more. But average investor thinks, oh, too dangerous, right? When in fact, it's the safest time to get in. So the smart money gets in very early when everybody else is telling them that they're crazy, and the market starts going up. And as other people on the sidelines see these people making money, they start jumping in. And you just climb up the hill of the cycle and you pull in more and more and more sort of casual investors or hot money investors. You see people who are like jumping on the bandwagon. And so you start to people jump in, drives prices higher. Other people see it, drives prices higher. And what you wind up having is a lot of people who are too late to make any money jumping in because they've seen all these people who got in early making money, right? And so you have this herd effect. And the same thing happens with not just the overall market, but like in real estate specific markets that people chase, right? And usually they're chasing them because the news is good, right? But what happens, as with anything else, if enough people pile into a safe investment, it becomes a risky investment.
True.
Right? Because the price becomes disconnected from reality, and then that's when crashes happen. So the crashes happen at the point at which people are not expecting them to happen. Most people, right? The savvy people start preparing for the crash and hedging against it, but your casual investor, the people who got in late, the hot money people, the FOMO people, they all think that this is going to go on forever because of recency bias, they think it's been going up and up. So therefore it's going to keep on going up and up and up. And, just to see like a real-time example of how this can burn you, look at Bitcoin. What happened with Bitcoin, right? So, so that's the dynamic. So you can take markets that are very, very, good fundamentals, right? High population growth, but if everybody piles into them, then you kind of arbitrage away all the opportunity. So that's what we've seen happening. And what this post was about zigging when people are zagging. So there are kind of four, I made this a simplification for the purposes of the post, but there aren't just 4 rules of multifamily. But I said, here are 4 rules of multifamily investing that you really ought to break right now for success. And so the 4 rules that I picked were: invest only in larger markets. Like, depending on, people will tell you, if you take a typical multifamily investing course, and frankly, my course says the same thing because this is good advice. The problem is there's no advice that's good for all times,
right?
As an investor. So you have to be understanding of the market, and all the rules of thumb that people talk about are always for like the average time in the market. They're not for the peak of the market, right? So, or the trough of the market, frankly, you can break them in the other direction at the bottom, right? So, but the first one is uh, larger markets. So at least 100,000 in population, or some people say 200,000 in population. The other is rapidly growing markets, right? I mean, makes sense. I'll explain the rules after I go through them. The third is uh, invest only in landlord friendly states. And the fourth is invest only in 100+ unit deals, right? And so the reason for the large market size is, well, liquidity. The thought is, hey, if it's a bigger market, there's more buyers, there's more, if when you want to get out of the deal, it's easier to get out of the deal. Whether it's a good deal or a bad deal, if we want to get out, it's much easier to get out in a big market. The second reason for the second rule is that, well, if you've got a really rapidly growing market, the idea is construction can't keep up. You're going to have really good demand dynamics. That's going to give you rent growth. It's going to make it more profitable. Your occupancy is going to stay high. The third rule about landlord friendly states, kind of obvious, like it's just easy to get rid of tenants that are troublesome, right? And then the fourth is 100 unit plus deals only. Well, you can get professional management that's higher quality. You can get your risk for one vacancy or one bad tenant is, it's 1% of your rent roll, as opposed to a duplex where it's 50% of your rent roll, right? So, all those, so those are good things to shoot for, right? However, when everybody is shooting for the same thing, and all of the real estate educators out there, the good ones and the bad ones, are all teaching the same thing.
Yeah.
So everybody is flooding into these markets. And it's not just the syndicators. I mean, it's also the institutional investors are subject to the same biases. And maybe and I see this all the time where people say, oh, well, like BlackRock is doing it, so therefore I should do it. And the thing that people don't understand about institutional investors is that there's a huge amount of CYA involved in institutional investing. Because if you are, let's just say you are like the 27-year-old acquisitions guy, this junior guy working at BlackRock, right? If you go and you buy a deal in some small market someplace because you've done the analysis and it looks really good, and then it doesn't work out, well, it's your fault. If you go and buy a deal, like just follow the crowd and buy a deal in, Austin, Texas, and it doesn't work out, you're like, well, not my fault. Everybody's doing this, right? I did, like it's the market, right? Not my fault. So there's an incredible amount of CYA involved in institutional brokerage, and they all buy into the same stuff. They all buy into this. They have the same biases that you have. They have the same FOMO that you have. I mean, they're still human beings, right? There's nothing special about the people who work at these places that makes them, they can afford the better analytical tools, but they'll just use them to justify the same biases that you and I have. And you can see a lot of them jumped into Bitcoin too, right? Because they're trying to make a buck, and now they got burned. So I mean, there's no special sauce at institutions. And if you read, say, for instance, Robert Shiller's book on irrational exuberance, he talks a lot about this, that the institutions were just as bad at predicting the financial crisis as anybody else. It wasn't individual investors, it was everybody. So let's put that aside. So anyway, when everybody's rushing into these markets, the prices get crazy. The competition is nuts. It's hard to find deals. When you do find a deal, the yields are super low. It becomes very hard to make any money. You see people doing all kinds of financial engineering to try to make the yields, which just is layering more risk on top of, when you're overpaying for a deal, that's risky. But then when you add on all this debt or these complex financial structures to try to get a little more return out of it, all you're doing is amplifying the debt. And it's good as long as things are good, but when things go bad, it gets bad fast, right? Because debt is a multiplier, right? Debt multiplies your returns, but it also multiplies your losses. So you got to be cautious with the amount of debt you use.
That's why I love this article, because you and I have been talking about multifamily and compressed cap rates for seemingly a year and a half now. And what I've seen the last 2 or 3 months is, especially, it's funny you mentioned Austin, Texas, because that was going to be the exact example I had. I have seen some financial engineering going on in deals that have come across my place in that state, specifically that city. I'm like, yeah, maybe this ends well, but yeah, I could win the lottery while standing on one foot, touching my nose and getting struck by lightning. It could happen, but it's scary, and it is definitely a herd. It's the herd. It's dangerous right now.
Yeah. And not with all plus with the combination of low interest rates
Yeah.
and also this fear of inflation, which may or may not be something to really be afraid of. We still don't know. I mean, the CPI has gone up, but like, I'll just give one example, and everyone's like saying, again, recency bias. So the CPI went up, it's going to go up forever. I don't know if you've been paying attention, but the price of lumber has plummeted.
40%. Yep. 42%.
Bottom dropped out of that, right? So because the supply chain issues have resolved themselves, just as the Fed was saying that they would. So, and everyone's like, oh, we don't believe the Fed. It's the government, so you can't believe it. They just lie about everything.
Well,
they do. Yeah, sometimes they do. Sometimes they don't.
Yeah.
But I don't get the sense that Chairman Powell is out there trying to lie about stuff.
No,
so
that's true.
So anyway, the point is that if you're trying, so that advice is good advice. However, when everybody follows it, it's bad. And if you're having trouble finding deals right now, what I would suggest that you do is start looking at other places, start breaking these rules.
Yes.
Right? And look for deals in other markets. Now, I'll give you some examples of why it's now maybe a good idea to break each of these rules. So the first rule about bigger markets, I don't really think this applies anymore. And the reason that I don't think it applies anymore is because there's a couple of reasons. One is that multifamily real estate is now a national market.
Yes.
Right. People have overcome their fear of investing outside their backyard. It's now become very common for people to invest outside of where they live. Right. This is the whole out-of-state investor phenomenon. Right. And so you can invest far from home, and people do. And what that means is that people are looking for deals nationwide, right? Yeah. And so, and they're looking for deals, even if they're looking for deals in their own state or near their own state, there's just lots of people. There are millions of people within 100 or 200 mile radius of pretty much anywhere in the United States, except for maybe Alaska, right? Where you've got investors looking for deals, and they're willing to drive a couple of hours to buy a property. It means the market is much bigger because of the internet. Just makes it so much easier to find property. And I think Corexy, I don't know if you're familiar with the site Corexy. I actually really like this site. It's the better LoopNet, essentially, is what it is. LoopNet used to be, and still is, I think, where people just dump deals that they couldn't sell. Deals go to die. Yeah. Corexy, on the other hand, is people are just listing their new listings on Corexy, right, to get a larger audience. Okay. And it's a very easy way for them to list deals and have it reach a lot more people. So I'm seeing a lot of brand new deals being listed on Corexy, not crap, right? Like real. This is the first place that they go. I mean, some brokers, like, for instance, in upstate New York that I've been dealing with, they're listing everything on Corexy, right? This is the first place they go. Okay. Because they know that they can reach a broader audience than they're going to get just on their website or just on their email list. And then they're building their email list by using Corexy as well. Cool. So that whole idea of like, you're not going to be able to sell your property because the market's too small, I think that doesn't exist anymore, right? As long as the market has some attractiveness to it. Right? And there may be markets that are just bad markets. That's a different problem. But if you have a market that's decent, just because it's small doesn't mean that you can't exit anymore. So Agreed. Put that aside. Okay. The second rule about rapidly growing markets, like you should only focus on those. I mean, again, it makes sense to focus on them. However, if everybody else is focusing on them and you can't get deals, well, it doesn't really help you. And what I've noticed over the last year of starting to investigate smaller markets, especially in upstate New York, is that a lot of these markets, even though they don't have very robust population growth, they have supply demand problems there, exactly. Right? Yep. So there's two ways to create favorable supply demand dynamics. One is too much demand and the other is not enough supply,
Mhm.
right? And so a lot of these smaller markets don't have enough supply. They actually have housing shortages because nothing has been built there for such a long time, because all the developers are focused on the bigger markets and the more
Mhm.
dynamic markets where it's a little more of a guarantee. They're a little bit risk averse. So they don't build in these smaller markets. What that means is that the housing stock is aging out. A lot of it is becoming, obsolete, too decrepit to continue to use. And so the housing supply is shrinking,
Yep.
even as the population is slightly growing or just being stable. That means that rents are going up. So you can have some of the same dynamics that you have in rapidly growing markets in some of these smaller markets that are not growing as well. The caveat here, though, is that you really got to dig into the numbers, right? You don't really have to think very hard about Austin, Texas, in terms of like the supply demand dynamics there, right? Because maybe you're going to want to avoid a submarket where there's a ton of construction, right? And maybe you're worried about absorption in that market, right?
Mhm.
But in that submarket, but overall, like you're not going to be terribly concerned about is the demand here, right?
Right.
In upstate New York, you probably want to be a little bit more like on top of those numbers, and they may be a little harder to find too.
That's true.
So, but you got to talk to brokers. You've got sometimes the towns have feasibility studies. Like, so I know I'm working on a construction project up there where the town happens to be in the town where we own a house.
Mhm.
The town put out a study a couple of years ago that said they have a shortage of 600 units in the town of, of, of
There
housing.
you go.
So, um, and housing actually turns out, there's a little bit of a tangent, but one of the big reasons why there's been this big population shift, people moving from northern states to southern states, people complain about the taxes, but it's actually not the taxes, it's the cost of housing.
Mm,
That's what's driving people, because people's cost of housing is their biggest cost,
for sure.
and the differential in taxes is not that much, but the housing costs are huge. So because stuff, the northern states have a lot of zoning laws and they have a lot of like impediments to building more housing, and especially the big cities, like the land is all filled up, it's very hard to build, so the housing costs are outrageous. California has the same thing. You
Mhm.
guys have your land use laws are insane out there,
Yes.
so it's impossible to build anything. So you've got people are moving because of the cost of building, right, and the difficulty of building, because it just drives up housing. But that's good for you. Like if you're buying in some of these towns, the rents are really. I'm surprised at how high the rents are in these towns,
Mhm.
because it's just because of the housing shortage. And the other thing too, the other interesting thing, is that because nothing really has been built in a lot of these places for a very long time, when you build something new, it sells out or gets filled up very fast, because the market is also starved for new apartments.
Yeah.
There's a segment of the market that wants to live in a brand new, shiny, state of the art, fully amenitized
Yeah.
property,
And has the ability to pay.
and has the ability to pay, and there's nothing available to them. So as soon as something comes on the market, like they're on it, right? Um, so that's another thing to keep in mind. Okay.
Okay. I like it.
Uh, landlord friendly state, only invest in landlord friendly states. Well, I mean, this one is like, at least for New York, I don't know about California, but for New York, the state is seen as very landlord unfriendly, but it's
Sure.
really because of the big cities, right? The state gets tarnished with the
Mhm.
reputation of the big cities, because obviously, New York City is the mover and shaker of New York State,
Mhm.
and we still have rent control here and rent stabilization, and it's only getting worse.
Mhm.
But upstate is basically unregulated, right? So you don't have these problems in upstate New York. So look at your state. Your state may, on the surface, be more landlord unfriendly, but maybe it really depends on the town or the county or the city that you're dealing with, right? So
Absolutely.
dig into that as well. You may be pleasantly surprised. And the other thing too to remember is that, well, this is sort of the fifth point. I'll get to that in a minute.
Mm.
Invest in only 100 plus unit deals. Again, everybody's going after those deals. The smaller deals, you can make money on smaller deals, right? And you're going to be able to get them at
For
higher
sure.
cap rates. To the extent that there are outside investors like chasing deals in your state or whatever town you're looking at,
Mhm.
they're going to be more looking after the big deals, right?
Yep.
So there's that space sort of below that where you can come in and get better cap rates, and the cap rates are going to be better in these markets anyway overall.
Oh, for sure.
Right? So so you can get, you know, better deals, less competition. You're basically only going to be dealing with, you know, for the most part, if you're looking at these states, you're only going to be dealing with competition from local investors who understand that you can make money here. And the thing to keep in mind is that, you know, I was always left scratching my head when people were saying, well, nobody wants to invest in New York. And I'm like, yeah, but there are people like making millions of dollars.
Yeah. What's going on?
What's going on? You know, so it's what you realize is that there's the perception gap, right? There's the gap between perception and reality. And when you can find one of those, right, that's a way to make money. Like that, you want to exploit the perception gap. You know, in some of the really hot markets, you actually wind up with like a negative perception gap because people have pumped it up so much that you may well not make the money you think you're going to make. And I've seen this happen where, you know, people go and they buy this value add deal, and then you see them dumping it onto the market a year later without having completed their value add because they realize they can't make money doing it. So, but they know that they can sell it to somebody else who believes they can do it because they believe the hype. And it's basically you're winding up sort of churning deals and basically flipping multifamily properties because you can't make money by, you know, doing a rehab and hold the way that people thought they were going to do it. So, but I think in these smaller markets that are starved for new product or starved for additional housing units, if you can go in and rehab something, bring it up to modern standard, you know, you're going to be able to rent it. If you can build something new, you're going to be able to rent it. And, you know, the sort of the fifth point of all this, well, I just sort of made it already, is that there are millions of people who are making money in real estate in these markets.
For sure.
Following the crowd, people who are not sitting on Facebook all day, not listening to podcasts, you know, not watching YouTube channels like this and following the same advice that, you know, everybody's giving who's on social media, but they're just, you know, and even in my Facebook group, when I posted this, you know, I've got a bunch of people who are already doing this, you know, who are just investing in their local markets. And they're like, you know, the comments on there were like, yeah, glad you finally figured it out.
Where have you been?
Where have you been? Yeah, this is what I've been doing this all my life, you know?
Yeah.
So,
funny.
So, you know, zig when the market is zagging
and
break those rules, because that's right now, you know, if you want to find deals, that's what you've got to do. You got to do something more creative, different, look where other people are not looking.
Yeah.
And I think that's really the key.
Yeah. What I tell people all the time is do the work, run the numbers in your market. Bigger isn't always better. That's a very common phrase I have. And if you're in my Facebook group, which means you're one of my students, you're going to see this post. I've asked Jonathan to, I don't know, copy and paste or share or whatever the right word is for Facebook. So you should see that post later in the day. So Jonathan, thank you very much. Where can people find you? What is your Facebook group?
Yeah, so the Facebook group is called Multifamily Investment Community. If you just search for it on Facebook, it'll pop right up. We are, as Michael said in the beginning of this segment, very vigilant about keeping out the spammers and the daisy chain deal posters and all that kind of stuff. This is a pure networking and value and education group. And the only kind of hurdle that you have to jump through to get in is that there are 3 questions you need to answer when you join the group. And unfortunately, Facebook only shows them on computers. And I don't admit people who don't answer them. So first time, log in from a computer, and then you can use your phone after that.
Very cool. And I'm a member of the group. I like it. It always puts out these thoughtful questions. Many of them make me scratch my head. So Jonathan, thank you very much for all you do.
Absolutely. Thank you.